Ladies and gentlemen, thank you for joining us in this webinar. The subject is tips for the tax year end. As we go into the new year, we're looking at small things that you can do, not necessarily small things that you can do to save tax. Two speakers this morning, the first being my RDP partner Mahesh, who will talk on the tax side, and then we'll hand over to John Haley from WILLOW Financial Planning, who will talk about some perhaps investment and pension opportunities that you may consider. Without further, the format will be Mahesh will give a presentation on some tax aspects, after which, if anybody's got any questions, please use the Q&A button at the bottom of your screen. And I will present them to Mahesh at the end of his presentation. Then we'll hand over to John and follow the same routine. When John is finished, a small Q&A session. We sincerely hope you find the session of benefit. And without further ado, I'll hand over to Mahesh.
Good morning, everybody, and a Happy New Year to you all. Just really going to run through the slides, just as David said, just to pick up some of the as far as we're concerned, so just basic tax planning points, which we should all be considering towards the year end. So just going to run through the slides. A nice and easy one: dividend taxation. Some people aren't aware, but regardless of what your income is, everybody is allowed to earn £2,000 in dividends, which is tax free. So some people think, well, if I haven't made sufficient profits this year, I can't vote a dividend. You should be looking at the corporation, the company's accounts, and take a look at, previous year's reserves being brought forward and utilising those to make, to obtain the £2,000 dividend allowance. Not only owner-managed businesses, but you can also utilise quoted shares. So, your BPs, your HSBCs, you can, if you've got £2,000 worth of dividends, it all helps, and it's absolutely tax-free. Corporation tax will come on to shortly. Again, from a personal tax point of view, we have capital gains, annual exemptions. Now, you may have heard recently, and we'll find out, I guess, on the 3rd of March with the budget, there is potentially going to be a clampdown on capital gains tax. Maybe the annual exemption may be removed, may be reduced, but there is a high likelihood in the March budget, if not this budget, then further down the line, one of the next budgets. We do expect to see a shrinking between the income tax rates and the capital gains tax rates, because there's a huge difference between the two at the moment. Income tax rates are 20%, 40%, 45%, capital gains tax rates, non-residential properties 10 and 20% at the moment. For residential properties, 18 and 28%. So there's a huge disparity between income tax rates and capital gains tax rates. So, if you haven't used those allowances, do use them. You can also utilize them between husband and wife. Generally speaking, interspouse transfers are tax free. So if you are disposing of an asset which is subject to capital gains, do think about just moving some of those assets between husband and wife before you action the disposal. Just onto the next slide, business asset disposal relief. The name keeps changing. Previously known as entrepreneurs relief, which was reduced to previously £10 million. So the first hit of £10 million of all disposals of a trading company would attract entrepreneurs relief at 10%. Recently, that's been reduced to £1 million only, and again at 10%. Anything over and above that is taxed at 20%. But again, just going back to the last slide, as I mentioned, there is a likelihood that capital gains tax rates will become more in line with income tax rates. And you may have read in the papers recently, there's been a lot of companies, owner-managed businesses, a lot of owners disposing of their business with a view to crystallising the gain now and paying tax at 10% rather than, potentially 20, 30, 40% in the future. So it's quite lucrative. And most smaller clients, £1 million is sufficient. We do have some larger clients where they will unfortunately have to take the hit. Just in terms of incorporation, as you're probably aware, trading as a sole trader or a partnership comes with its own tax disadvantages. The main one being national insurance, really class 2 and class 4. We can overcome that by incorporating a company, providing you with, a salary plus dividends, which not only makes it tax efficient for you, but also a lot of people, under the misconception that, okay, if I've got a small salary, it's not going to qualify for pension purposes, state pension purposes in the future. And we can work around that to ensure that although you're not paying any national insurance, it still qualifies for state pension purposes, qualifying years for state pension purposes in the future. So, if anybody out there is trading as a sole trader, partnership, we can run the figures, put them on a spreadsheet, run the figures between what you're paying now in terms of tax liabilities and what you'd pay if you did incorporate. One of the other big advantages with incorporation, obviously, is limited liability from a commercial perspective. And cash flow. Cash flow is a big one these days, and as everybody knows, within COVID at the moment, cash is king. Everybody's trying to preserve the cash. With companies, generally speaking, the corporation tax is paid 9 months and 1 day after the company's year end. So potentially, from the start of the accounting period, you have 21 months to pay the corporation tax. With a self-assessment, as you're probably aware, on the 31st of January and 31st of July, you will pay in-year payments. So again, from a cash flow perspective, it makes a lot of sense. Capital allowances, the annual investment allowance remains at £1 million. So if you're buying vans, machinery, plant and machinery, anything up to £1 million must be spent within the company's accounting period. And the first £1 million, you'll get 100% tax relief in year 1. So again, it shouldn't be overlooked. Research and development tax credits. This is something that has been around for a few years. Mainly, larger organisations look at it, but there's, we have a lot of smaller managed businesses which, create something new within their business with a leading cutting edge, and they're quite lucrative. You can get 130% uplift in what you spend, and maybe one thing to cover off on the R&D tax credits is some people, sometimes people think, well, we're not making any money. What's the point of employing somebody to look at the R&D? It's not just a case of offsetting it against the company's corporation tax. If you are making losses, you can take a tax credit in cash at a lower amount from the revenue. So you calibrate your revenue and say that we've spent X amount on R&D development. We can't offset it against our corporation tax liability because we don't have one. And so you can claim a tax credit in cash from HMRC. Personal tax, probably jumped the gun a little bit. I think when I spoke about interspouse transfers on capital gains tax, which I'd covered off. An anomaly in the tax rates is not many people know, as I said earlier, income tax rates are 20, 40 and 45%. There is an anomaly. So if your income ranges between 100 and 125,000 pounds, the effective tax rate is just over 60%, which a lot of people don't know. The maximum tax rate, income tax rate, is 45%, but you can be paying tax at around 60% between that tax bracket. So, anybody within that, if you're earning £200,000-300,000, it becomes irrelevant. But anybody within that tax bracket should, strongly consider, well, how do I bring my income down below the £100,000 threshold in order to preserve my personal allowance? Because the way the tax system works is for every £2 you earn over £100,000, you lose £1 of your personal allowance until you hit the 125,000 limit. And one of the easiest ways to bring it below the £100,000, let's just say, for example, you've got somebody on, earning £110,000. They're quite able to put £10,000 into their pension scheme via salary sacrifice, which would bring their income down to £100,000 and effectively save tax at 60%. So definitely worth considering. The next point, salary versus benefits, again comes back to the point above, just to ensure you're not within that 125,000 pound bracket. It's just, sacrificing part of your salary for benefits. Nice, easy one. Inheritance tax. There's a number of allowances available for inheritance tax purposes. The main one is you can gift £3,000 a year, and you also have a £3,000 a year brought forward allowance. If you've got, if you're gifting out of income, so just as an example, if your income is £100,000 gross and you've left you £60,000 and you spend 20,000, the balance of £40,000, if you're gifting out of income, the £40,000 that remains, none of that will be subject to inheritance tax. So you normally have a 7-year time clock which starts ticking the day you gift an asset. If it's out of your income, then it's not, the 7-year rule doesn't apply. Onto inheritance tax. Yes, I mean, if you leave at least 10% of your assets to a charity, the effective rate of tax for IHT reduces from 40 to 36%. Passing on your pension is extremely tax efficient. They're constantly changing the rules in terms of pensions, and whether it's subject to IHT or not. I'm so sure John will pick up on this a little bit later. But these days, having a pension is quite lucrative for IHT purposes. And trusts, obviously, if we create trust, whether it's gifting to children or grandchildren, anything that's gifted into a trust, potentially the gain can be held over, so you're not crystallizing a gain immediately. And again, it can work very well for school fees, younger children. And once you gift something into a trust, provided you survive 7 years, it falls outside of your IHT estate. But there's a lot more in terms of the tax consequences of running a trust, and the 10-year tax charge, etc. So again, contact us, contact John. We can look in trusts for you if that's something that interests you. Pensions and tax. I think I've got 3 minutes left, so I'm just going to try and rush get through these slides as quick as I can. Pensions and tax. At the end of the day, this is. Hang on, John. Is this for you?
No.
Is it for you or me?
You, Mahesh.
No, you're fine. Yeah, I'm talking more about the contribution end, so that's absolutely fine.
Okay, fine. So protecting your pension, probably about 10, 12 years ago now, they brought in some stringent rules. Yeah, if your pension pot exceeds, just over £1 million, we need to take a look at it. You don't want to start contributing into the scheme. And the next point, stakeholder pension, you don't need to be earning income in order to make pension contributions. Now, the last point, the stakeholder pension, everybody's entitled to a net contribution of £2,880 a year. What people don't realise is that also includes minors, so it can include a 1-year-old child or 2-year-old child. So again, from an IHT, if we're switching over from IHT to pensions, somebody, a grandparent, could put £3,000 into a pension scheme for a grandchild. That would be IHT free because it's covered by the annual exemption, and the child could effectively claim 20% off the government, even though they haven't paid any income tax. Pension drawdown, yeah, the flexible rules now. If you're over 55, you can start drawing your pension. You've got the 25% tax-free allowance. Unsure whether that's going to be around forever, but let's see. Who knows? The annual pension allowance, the amount you're allowed to contribute into your pension scheme, is £40,000 a year, depending on your income, obviously. If you don't have £40,000 worth of income, then that gets reduced. Tax-free pension contributions, I think it's self-explanatory. There's a number of tax-efficient investments out there. ISAs, yes, it's taxed money before it goes in, but again, I think people tend to think, well, if it's only £5,000, I mean the maximum is £20,000, but people tend to think, well, it's only £20,000. What people fail to realise is, over 30 years, that's £20,000. Over 30 years, that's £600,000 plus growth, which is outside the scope of income tax, capital gains tax. So like your principal private residence, your own home, Try and use your tax allowances, especially your ISA allowances, if you possibly can, if you have spare cash flow. Income tax relief schemes, EIS, SEIS, enterprise investment schemes, seed investment, enterprise investment schemes, venture capital trust investments, very good to try and bring your income tax rates down, but they are there can be your capital can be at risk, so you just need to go into any of these schemes with your eyes open. There's other bits and pieces, life assurance bonds, offshore bonds, which can grow tax-free. Again, just contact us if you want any more information on any of these investments. Takes me to my final slide, and I'm on time at 11:15. So questions and answers, please.
I've got no questions through the Q&A button. Anybody wish to post a question? Right, apparently not. Thank you, Mahesh, for a whistle-stop tour of taxes. John, we'll hand over to you. And if there are any Q&A, if anybody thinks of any questions at the end of the session, which they'd like to address to Mahesh as well, please feel free. I don't think John will mind if we share question time. So while he's setting up his screen, there we go.
Excellent. Okay, so I'd like to build on some of the detail that Mahesh gave you there. And just very quickly, a little piece about Willow Financial Planning, just really to say that Willow Financial Planning are independent financial advisors. So anything that we're involved with isn't tied to a particular fund house or provider. It's truly independent in that sense. So as you can see from the slide, we're highly qualified, as you'd expect, and they've got lots of experience if you do need help from us. Now, Mahesh gave some headline kind of detail around pension contribution, but what I'd like to do is just contribute or think a little bit more about the detail behind it, and dig down a bit more into the reasons why, and hopefully, if you're not putting too much into pensions already, hopefully give you an idea of the real benefit. They're a very powerful tax planning tool that we have in our kit bag to save tax and plan for future generations and reduce your tax position. Now, as Mahesh mentioned, you can pay in, as an individual, you can pay in up to 100% of your pensionable earnings every tax year and receive tax relief on that. So if you're earning, say, £20,000, £30,000, if you could afford it, you could pay all of that in and get tax relief. However, there's a limit to that, and that limit is £40,000 as the annual allowance as it's known. So if you were earning, say, £60,000, you could contribute 40 with tax relief, and to go beyond would mean you didn't get any tax relief there. In terms of the measurements, as you can see there, I've mentioned it includes all pension savings. So what I mean by that is if you do have a number of different pension schemes around the market, and there are contributions going in, it's not just your contributions that count against the 40,000. It's the contributions from your employer as well. So all pension schemes, all sources, employer and employee, you top all of that up against the £40,000. And as we'll see, you can potentially go beyond £40,000 by picking up allowances from earlier years, and I'll talk about that in a while. So the headline annual allowance is £40,000. However, as with many of these things, we tend to get a bit more complicated in terms of the legislation, and there are some quirks in the system. So if you are lucky enough to be a high earner, and by a high earner I mean somebody earning £200,000 plus, you can end up in a position where your £40,000 allowance is taken away from you on a 2-for-1 basis. So I mentioned there this thing called adjusted income. So adjusted income is your income from all sources for the tax year, pensionable or not. So rental income, dividends, the whole shebang. Plus any pension contributions that are being made for you, and by that I mean employer contributions. Once that number is 240,000 or more, you start to lose that £40,000 allowance. And I'll cover that off a bit more on the next slide. So, you know, thinking about housekeeping, if there is any way that you can speak to RDP or indeed us at Willow to try and reorganise your income so that you can reduce it to below the key numbers, that could potentially help you save tax, because you could end up in a position where you end up paying a bigger pension contribution than the allowance you're actually left with, and that leads to a tax charge. So high earners at one end, and then you've got, as Mahesh already mentioned, those with no earnings or very low earnings. So even if you had no earnings, you can contribute up to £3,600 a year and receive tax relief on that, even though you may have paid no tax at all. And as we'll see later, I'm going to make a bit of an argument that actually you may want to spend some of your £20,000 ISA allowance against that pension contribution and put the rest into ISA for tax reasons that I'll outline. And then the other annual allowance we have to deal with is something called the money purchase annual allowance. So if you are somebody who is perhaps carrying on working and does intend to carry on making pension contributions, you have to be very careful that you haven't reduced your annual allowance, because if you've got if you've taken income from a pension plan that's flexible, so by that I mean things like drawdown, flexible annuities and so on, your £40,000 is instantly reduced to £4,000. So it can be quite a big decision to make around that as well. So the headline is 40, but there are some wrinkles that we need to be very careful to make sure you don't trip over, because they can lead to tax. Now, I mentioned the tapered annual allowance. This is the government's current effort, and it has been eased recently, but it's their effort to save some money, because pension tax relief costs the UK government something to the tune of £40 billion a year, which they're not overly happy with, because it's a big chunk. And what they've identified is it's the individuals with big earnings that receive the lion's share of that tax relief. So, as I've already outlined, they installed the tapered annual allowance in 2016. In the April just gone, they've upped the numbers because too many people were being impacted by it, especially those in the NHS who were deciding to retire rather than pay tax. So that's why they've changed it. Now, I won't dwell too much on this, but the point is there are two thresholds, the 200,000 threshold and the 240,000 threshold. The bottom line is, if we can get to a position where your threshold income, the 200,000, that number is 200,000 or below, then the tapered annual allowance doesn't apply. So if you were somebody who was earning £210,000, for example, and you made a £10,000 personal contribution out of your own resources, that would reduce your threshold income to £200,000. And the tapered annual allowance wouldn't apply. And it is potentially possible to be in a position where you end up losing annual allowance if your adjusted income is too high. So that is a session, believe me, in and of itself in terms of the detail. But just the main message is, if we can control things a bit and get threshold income down by way of organising your income, if we can do that, and by way of an individual contribution from yourself, we could potentially fix the problem. And all I'd say really is, if you end up with excess contributions, it doesn't matter if the employer made the contribution or you did. It's the individual that ends up with a tax charge on the excess annual contribution. So that's something we really want to avoid if we can. Now, I mentioned before, we've got the £40,000 allowance for most individuals. However, if you're looking to contribute more than that, there is a facility to look back to the 3 previous years. So we've got an individual here who's contributed or will contribute by the end of this tax year £12,000. So they've got £28,000 of unused allowance for this tax year. But if they had a pension plan in place for the earlier years, we can actually look back to those as well. So assuming the same pattern, we've got £28,000 of unused allowances from those earlier years as well. So potentially this individual could contribute in 2021 tax year £124,000 into their pension. And all you're doing with carry forward, as it's known, is sweeping up all your unused allowances. Now, things to be aware of: if you're an individual who wants to make that £124,000 contribution, you would have to be earning £124,000 in the tax year to get tax relief. However, if you are the director of a company, the company could make that £124,000 contribution for you, subject to different rules, the corporation tax relief rules, wholly exclusively for the business, for the purposes of the trade, etc. But you could actually make a bigger contribution by sweeping up allowances. And I suppose the key point, the ticking clock, is that if you've got a history that's a bit more intricate than the one I've outlined here, where you've got, you know, large unused allowances in 17-18, on the 5th of April, 6th of April, end of the tax year, 17-18 will fall out of account. So it may be worth dusting off your contribution history. If you are looking to retire shortly and sell your business, it's a great opportunity to remove profit from the company in a tax-free way. Now, in terms of contribution mechanics, I just wanted to outline how things work to highlight the tax position and the benefit for you. So we have an individual earning £80,000 a year, and he's already a member of his workplace pension scheme. He's paying 5% a year, and his employer's paying 3% a year. So in total, that's £6,400 a year of contribution. He's got £60,000 in savings already, and he wants to maximise his pension contribution. So he's already paying 6,400. So remembering that the employer contribution counts as well. So he's got 33,600 left of his annual allowance for this tax year. So we're ignoring carry forward for the purpose of the exercise. So the way it works, if he's paying into his own pension plan outside of the company pension, if he wants to pay that 33,600 in, he needs to only write a cheque or send money for £26,880, because when that's paid into the pension, that's when he receives the boost of basic rate tax relief. So 33,600. So it costs him a lot less, and he gets that instantly within the pension plan without any investment straight away. So that's a 25% uplift on the amount that he paid. Then when Steve does his self-assessment for the year concerned, he would then get to claim his higher rate relief because he's a higher rate taxpayer. So working the numbers out, that's another 5,200 that could, come back to him after self-assessment. So nearly £12,000 of tax relief, drastically reducing the amount of tax he would pay on his £80,000 of earnings. And obviously it's the 33,600 that's in his pension plan, now growing, subject to compounding and so on, for his retirement and the future. So very powerful. There are other ways you can obviously obtain versions of tax relief, such as EIS and VCT and so on, but you can't control your risk. At least with a pension plan, you can control your risk by investing appropriately inside it, subject to your own risk parameters and tastes. Now, this is really to illustrate the point I was making around pensions versus ISAs, both excellent vehicles, but there are reasons why you may decide to contribute into a pension if you can. So not a very attractive title, but it's the pension spider, I've called it. And it's really showing the numbers. Because one criticism some people might say is, well, if I pay into an ISA, I can get all of the money out tax-free. If I pay into a pension, some of it comes out as income, and I'm going to pay income tax on it. So what do the numbers look like? So if we are a non or a basic rate taxpayer, we as we've already outlined, can send £80 to a pension company, and it instantly becomes £100 because of basic rate relief. So that's our cost of that £100 pension fund. If we're higher or additional rate taxpayers, our cost of that contribution after all reliefs and so on, as a higher rate taxpayer, it cost me £60 to end up with £100 in a pension fund. And as an additional rate taxpayer, £55 because of 45% tax. So we know our costs on the way in. We know the pension fund we're going to end up with. What if we actually drew the money out again? Well, if we're a non-taxpayer, we can draw out £100. 25% of that is tax-free cash. 75% of it is income, but we're a non-taxpayer, so we don't pay any tax, so we end up with 100. If we're a basic rate taxpayer, after all taxes, we walk away with £85, higher rate £70, additional rate £66. So there's a couple of messages here. One is, if you were, say, a basic rate taxpayer without any investment risk, you've turned £80 into 85 if you were to encash it immediately if you're 55. But other than that, there's things to think about in terms of financial planning, because if we play things well and we do it correctly, we could end up, you know, costing, as a higher rate taxpayer, funding our pension as a higher rate taxpayer, costing £60 to get to the 100. But actually, when we retire, we are a basic rate taxpayer because we've managed our affairs accordingly. We've built up wealth across different wrappers. So we're at a cost of £60. We're walking away with 85, and this is without considering any investment returns or growth as well. So really illustrating how the tax works. Simplified, because if you've got a big pension fund, you know, £100,000, you know, obviously you can't draw out the whole thing as a basic rate taxpayer, but it's really to illustrate the numbers in terms of slices and how that works. And if we think about an ISA, if I pay £80 into an ISA, it stays as £80 for getting growth because there's no tax relief. And if I draw it out, it stays as £80. So, you know, there is something to think about there. So as I said earlier, if you've got £20,000 to put into an ISA, you might think about putting £2,880 into pension, becomes 3,600. And if your tax affairs are correctly aligned, you could improve your net position, even if you drew it out at a later date versus an ISA. And just to give you a bit more detail there, if we compare ISAs and pensions, obviously with an ISA, we don't receive tax relief on our contributions. With a pension, we do, as long as we're within all of the rules. Once the money is inside a pension, once the money is inside an ISA, it grows exactly the same. There is no difference. They're both tax-free in terms of how they grow from the different assets within the investment funds that you're in. So no difference there. Difference is with a pension, you've boosted yourself straight away at a smaller cost with the tax relief. In terms of access, this is the biggie really for me. With ISA, you can obviously get your money back at any point. With a pension, you've got to be 55 at the earliest to get your money out. So if you're happy that the money is locked away until you're 55, there is some serious thought to be given to thinking about pension before an ISA. And the other one that Mahesh touched upon is with ISA. ISAs are fantastic wrappers during lifetime. They're tax-free. There's no capital gains. There's no income tax. All very simple. However, when you pass away, the ISA wrapper dissolves and it is then potentially subject to inheritance tax. So you could lose 40% of the funds that you've actually worked hard to build up. Within a pension fund, you are, you know, in a general position protected from inheritance tax. And what's more, the fund can be passed on to your family in a very tax advantageous way. So you're preserving that. You don't lose 40% on death. And then, of course, benefits is already outlined. With an ISA, everything is tax-free. With pension, you can have 25% of your fund tax-free and 75% subject to income tax. But as I outlined on the previous tax spider, even in that position, you're still in a positive position if you play your cards right in terms of entry and exit and your tax position. And then, of course, with an ISA, you could build up any size fund in an ISA. Within pension, you've got this lifetime allowance to contend with, which is another way for the government to control their tax relief spend. So that's currently 1,073,000. I'd suggest that's you know, quite a bit of money for most people. So it's probably a moot point for some in terms of the size there. So thoughts around pension contribution before ISA. And then just other aspects to touch upon. Mahesh mentioned this. So a quirk of the tax system is that once your income hits £100,000 and goes above that, you start to have your personal allowance taken away, your tax-free slice of your income on a 2-for-1 basis. So by the time you hit £125,000 of income, you've paid an effective rate of 60% of tax because of that loss of your personal allowance. So that's not a good place to be. However, pension contributions can help. So if you've got an individual who's earning £125,000 and they make a contribution of £25,000 gross, so that's the gross contribution, so it will actually cost them £20,000, as we outlined earlier, that will restore their personal allowance because their adjusted net income is reduced to £100,000 because of the pension contribution. So on the flip side, that actually gives us an effective rate of 60% tax relief on the pension contribution because we recoup our personal allowance as well. And then in a similar vein, we've got the loss of child benefit. So, if you're in a position where anybody in your household is earning more than £50,000 and child benefit is being claimed, the person earning the 50,000 plus will end up paying more tax to claw back the child benefit. So basically every £100 you're over £50,000, you pay back 1% of the child benefit that's being claimed. So once you hit £60,000, there is no child benefit. It's still paid, but it's wiped out by extra tax. And again, pension contributions can help here. Because if you were to make again a £10,000, if you're earning £60,000, losing all of your child benefit, and you make a £10,000 gross pension contribution, then you avoid that extra tax to wipe out the child benefit. And this can be done, as Mahesh mentioned, this could be done by an individual contribution, or it could be done via salary sacrifice to reduce your pension downwards with the employer making that contribution. So again, things to think about before the end of the tax year to review your position. And then third-party contribution. So again, Mahesh mentioned this at the higher level. You could actually, if you're feeling generous, you could actually make pension contributions for other people, for your children, for your grandchildren. So for your grandchildren, you could be making a contribution of £3,600 a year for them that would only cost you £2,880. That'd be a fantastic nest egg for them. I did some numbers earlier. If you paid in £3,600 each year for your 5-year-old grandson or granddaughter for 5 years, by the time they're 55, that fund would be worth over £300,000 with a 6% growth rate, which isn't unusual in the longer term, or inconsistent in the longer term. So that'd be a fantastic nest egg, a good way to start them off. If you've got children or grandchildren who are higher or additional rate taxpayers, you could actually make a pension contribution for them. They would receive that basic rate relief, but they could also claim the higher and additional rate. So unfortunately, it doesn't do anything for your tax position, but it could form part of your own inheritance tax mitigation plan in terms of reducing the size of your estate there as well. And the message is, I suppose, the power of compounding the tax relief you've received. The earlier you start, the better, really, especially if you're dealing with your grandchildren. As I say, fantastic start in life and pension planning for them for the future. And then just to finish off, really, I've talked specifically about pensions today, but actually retirement is more about building up wealth across different assets. So pensions is just one aspect. So we have ISAs, we have unit trusts and OICs, we have onshore bonds, offshore bonds, venture capital trusts, and so on. And if you are lucky enough to be able to build your wealth across different tax wrappers, they've each got their own different facets in terms of how they fit into the tax regime. So if you're able to plan your affairs and manage your income, if you're starting with zero start point and you can fill up all the little buckets that we have available, you could have £32,800 each year tax-free formed of capital and income, without paying any tax at all. And if you're a couple, you've obviously got double that amount there. So it isn't just about pension. So it's worth thinking about spreading wealth to build your wealth in different tax regimes. And of course, that mitigates the position for you as well. Mesh mentioned the budget coming on the 3rd of March. Well, if you've got wealth split in different tax regimes, then if the Chancellor tweaks certain things on one side, you've still got a foot in a different camp. So it's diversifying your wrappers as well against tax threats, which can be really useful. So in terms of my final slide, really, the pension annual allowance is very valuable in terms of the example I gave with Steve. You can obtain some great results in terms of the tax relief that you've got available. And of course, you've got the ability to use carry forward, which is very powerful, certainly for companies that want to get some money out and receive corporation tax relief on that, as well as individuals. And as I say, the key point is the 6th of April change over to the tax year. Tapered annual allowance, well, it's possible to reinstate the full annual allowance, but it requires a bit of a review of your position and income to see if that can help there. And of course, recouping your lost child benefits or personal allowance, again, with that 60% relief on your personal allowance is fantastic. Child benefit, the relief number differs depending on how much child benefit you're claiming as well. And with third-party pension contributions, if that's something you want to do for your grandchildren, in the knowledge that it's locked away until they're 55 under current rules, then that's a great place to think about building wealth for them as well. And of course, Mahesh mentioned the budget on the 3rd of March. Although we've got the deadline of the tax year to think about, actually, I'm not one for scaremongering, but I mentioned the tax relief cost of £40 billion a year. It's been rumoured for a number of years and nothing's happened. But with the COVID debt that's been built up, there is a potential threat, I suppose, that Rishi Sunak could make changes to the tax relief system as well. So if you want to make a pension contribution, it may be sensible to get that in place before budget day, because if he did make changes to tax relief, it would probably be from midnight on the day of the budget to avoid sell by dates and people piling in anyway. So please think about that as well. I hope that's been useful for you, and I'm happy to take any questions you may have. Thank you.
Lovely, thank you, John. We've got a string of questions here. We'll run through some of them if we may.
Yeah.
First one, a question from Chris about R&D. Chris, I'll get somebody from the team to contact you regarding R&D tax credit and if it's relevant for your company. A question here, can you explain the pension part? If I invest, say, 30,000 into a private pension, does this come off my tax sum owed at end of tax year, or is it added by the pension provider on the money I pay?
Yeah, so okay, so if you were to write a cheque or send money for £30,000, inside the pension plan, that would become 37,500, so 20% tax relief. That's added by the company. Depending upon the pension provider you use, some are big enough to actually fund that tax relief up front. So it is an instant boost. 30 becomes 37,500. Some smaller pension providers would invest the 30,000 and then have to claim that tax relief from HMRC. So you'd have a lag in terms of that position. So that's your basic rate. If you're a higher rate taxpayer, you would then claim the additional 20% relief on the 37,500 contribution that's been made. And that will be dealt with in your self-assessment.
As a reduction in tax?
Yes, and that will reduce the tax. Absolutely.
Okay. Question from Mahesh here. Are there any allowances we can use for working from home which don't affect the value of our home when we sell?
It's a difficult one. It's minimal, to be completely honest. The revenue has said, I think it's £6 per week at the moment if you're working from home. The other alternative is what you can do, and I've known people to do this, because the whole question, well, I suspect the question's been raised because obviously if you live in your house and you use it for business purposes, what you don't want when you dispose of the property is for there to be a capital gain which is subject to tax, because if it's your own principal private residence, then there's no tax on the gain of the property. Now, well, another thing, I mean, it's not ideal, but another avenue you could potentially look at is, well, if you're not working from home, you know, your annual bills, let's say your heating electric bills are £1,000, but now you're working from home are £2,000. The extra £1,000 that you're incurring as a result of working from home, you can claim relief on that, which is more than £6 a week. But again, it's not a huge amount. I mean, we want to stay away from claiming council tax, you know, repayments on your mortgage, the interest, etc., because all that will happen is part of your capital gain when you come to dispose of the property will be unfortunately subject to capital gains tax.
A question for John. What's the youngest you can start a pension for your children?
It could be for a newborn, as long as the pension company's got the contract for that. Legislation will allow a newborn baby to have a pension plan.
And one more question, I think, for you, John. Would now be the best time to draw a tax-free lump sum from pension, and more sums as drawing if the income is low? Is there a tax benefit?
Say that again, David. So tax-free cash now. What was the second
Would now
part?
be best time to draw a tax-free lump sum from pension?
Yes.
And more sums as drawings if the income is low. Not quite sure what that means.
No. So I'll deal with the tax-free cash first. I'll think about the next part. So I think what that's getting at is the potential threat, I suppose, in the next budget that Rishi will say tax-free cash is going to be changed. I can't, you know, never say never. I can't say that's impossible. However, as an advisor, I find it hard to believe that they would go that far. Simply because pensions need to provide an incentive for people to save, because there's a savings gap at the moment anyway. People haven't saved enough into pensions and rely on the state. So to take that away would be very, very sort of severe, I would say. And not forget that some people have what's known as a pension mortgage. So they've built their whole plan around the pension growing to enough of a point, the tax-free cash, and pay off the mortgage. So that would undermine lots of people's planning. So I wouldn't go that far. I wouldn't say withdraw tax-free cash before budget, but you know, I can't say that's not going to happen. Don't forget as well, within your pension plan, as we've already mentioned, the pension is outside of your estate for inheritance tax purposes in the majority of cases. If you draw your tax-free cash out, it's now in your bank account, and if you were to pass away with a sizable estate, you're going to lose 40% of it to inheritance tax as well. In terms of the income side of things, yeah, if you've got low income and you can use your allowances, I'd always say use your personal allowance with your pension income, but without seeing more detail for the individual concerned, it's hard to answer that one. But certainly use your pension to use your personal allowance each year if you can.
Lovely. Some of you have asked if you can get copies of the slides. No problem, those will be circulated after the webinar. And some of you asked specific questions, which I will, relating to your personal circumstances, I'll direct those to John and ask John to contact you direct, if that's okay. Yeah. I think that more or less covers it. Wish you all a happy new year. Stay safe, stay at home, as they say. Wish you all well, and let's hope that 2021 proves to be a better one than 2020. Many thanks for joining us.
Thank you.
Thanks very much.